I've been comparing the 2020s to 1940s since the beginning of the 2020s, and it's already been directionally similar, which is that we've had inflation much higher than yields. Anyone holding currency or bonds got absolutely killed compared to anyone holding equities, real estate, gold, Bitcoin, high quality private equity, and fine art, things like that, right? Basically, we've kind of partially recollateralized balance sheets by devaluing a lot of this.
If that trajectory holds, then the conversation about inflation being temporary becomes irrelevant. A system that is adding $2 trillion of debt every year is not operating in a way that supports stable purchasing power. It is operating in a way that prioritizes continuity. That distinction matters because it changes what policymakers are optimizing for. The goal is not to reset the system. The goal is to keep it functioning under increasing pressure. The reason that pressure matters is because debt changes how policy works. At lower levels of debt, central banks can raise interest rates aggressively to suppress inflation without destabilizing the broader system. At higher levels of debt, the same action produces amplified consequences. Each rate increase feeds directly into higher interest costs across governments, corporations, and households. That reduces spending capacity, tightens financial conditions, and increases the probability of defaults in weaker areas of the system. This creates a constraint that limits how far tightening can go. Inflation can be slowed, but fully eliminating it requires a level of restriction that the system may not be able to absorb. This is why policy responses often appear incomplete. Rates rise, inflation moderates, but before it fully returns to target, something else becomes the problem. Liquidity stress appears, credit markets tighten excessively, financial institutions come under pressure. At that point, the focus shifts. That shift is not theoretical. It has happened repeatedly. Each time tightening reaches a level that introduces systemic risk, policy adjusts. The pace of tightening slows. Liquidity measures are introduced. In some cases, balance sheets expand again. The system stabilizes, but the underlying debt remains.
Since they got out of colonialism, really going back to the 50s and 60s, they've managed to avoid hyperinflation or any sort of triple-digit inflation, which is kind of notable for a country at that level of development. But they have averaged double-digit inflation throughout that period. And we look at the money supply growth. I mean, it'll be 20% typically a year. It would get higher, say, during the kind of the post-COVID years.
That means the next cycle begins from a higher base. This pattern creates a long-term dynamic where inflation is not fully removed from the system. Instead, it becomes part of how the system adjusts to its own constraints. When debt cannot be reduced directly without severe consequences, it is reduced indirectly. Inflation allows the real value of that debt to decline over time. This is not an explicit policy announcement, but it is an observable outcome. The mechanism is straightforward. If inflation runs above interest rates, the real burden of debt decreases. Governments repay obligations in currency that has less purchasing power. This process is gradual, but over multi-year periods, it is highly effective. It avoids the disruption of defaults while still addressing the scale of the debt problem. The cost of that process is distributed across the economy. Holders of currency and fixed income assets experience a reduction in purchasing power. This is not always immediately visible because it occurs over time. However, the cumulative effect is significant. It changes how capital is allocated and how individuals preserve wealth. This is why asset behavior shifts in these environments. When real returns on safe instruments are compressed, capital moves toward assets that can maintain or increase purchasing power. Equities, real estate, commodities, and other scarce assets become more attractive. This is not necessarily because their intrinsic value has changed dramatically, but because the alternative, holding currency, has become less effective. You see, at the same time, this shift introduces new risks. Asset valuations become more sensitive to changes in liquidity and policy expectations. When conditions tighten, repricing can be sharp. When conditions ease, recoveries can be rapid. This contributes to the volatility observed in modern markets, where movements are often driven as much by policy expectations as by underlying fundamentals. The structural drivers behind this dynamic are not short-term. Debt levels, demographic trends, and fiscal policy create long-lasting constraints. Aging populations increase spending obligations, particularly in healthcare and pensions. Fiscal deficits remain persistent, even outside of crisis periods. These factors reduce the likelihood of sustained policy tightening at levels that would fully suppress inflation. Instead, the system operates within a range. Inflation rises, policy responds, stress emerges, and policy adjusts again. Over time, the baseline shifts, not necessarily in a straight line, but in a way that reflects the underlying constraints. This is why expectations based on previous decades may not fully apply going forward. For investors and savers, this changes the framework. The question is not simply whether inflation will rise or fall in the next year. The question is how the system manages the interaction between debt, policy, and purchasing power over longer periods. Understanding that interaction provides more context than focusing on short-term data points alone.
If you're holding gold, and let's say you're not paying any security fees on it, you're just holding gold, you're not getting a yield, but you're not really paying much in the way of expense ratios, you're getting diluted by something like 1.5% per year, which is not super rapid. If you add a little bit of expense to it, you can round up to 2% a year, maybe that you're getting diluted after security fees and stuff like that. If you're holding Bitcoin, then apart from security fees, you're not really getting diluted at all over the fully diluted kind of long arc of time. If you include near-term dilution, it's less than gold. If you're holding, say, treasuries, you say, okay, well, I'm getting depends on what duration you're holding, but you're getting a 4% yield. You're facing 7% money supply growth, so you may be getting 3% net dilution.
That example translates the structural dynamic into a direct outcome. If the growth of money supply exceeds the return on the asset being held, the holder experiences dilution. This is not always framed as inflation in the traditional sense, but the effect is similar. The purchasing power of the asset declines relative to the broader system. This is why traditional measures such as CPI do not capture the full picture. Inflation is not uniform. It affects different assets and sectors in different ways. Some areas may experience rapid price increases, while others remain stable or even decline due to productivity improvements. The overall effect depends on where capital is concentrated and how supply responds. In this environment, the concept of scarcity becomes more important. Assets that cannot be easily expanded in supply tend to respond differently to monetary expansion than those that can. This creates divergence in performance across asset classes. Understanding that divergence is critical for navigating the system effectively.
If you're holding a very high quality equity, you might be getting negative dilution. Maybe they're buying back their own shares and those shares are getting more scarce. But then the question you have to ask, are you getting diluted in terms of market percentage, right? So if you're holding IBM shares, your total percentage of all IBM shares might be doing fine because they're buying back their own shares, but your ownership of say the cloud computing space or the overall kind of commercial computing space has diminished because you've been diluted by other mega cap companies that have kind of eaten IBM's lunch, for example.
The broader takeaway is that the system is not structured to maintain constant purchasing power over long periods when debt levels are elevated. It is structured to remain functional. Inflation, in this context, is part of the mechanism that allows it to do so. Interest rates are managed within constraints. Policy adjusts based on stability considerations. And the interaction between these elements shapes outcomes over time. The implication is not that the system is about to fail, but that it operates differently than many assume. Recognizing that difference allows for more informed decisions. It shifts the focus from short-term fluctuations to structural trends. And in an environment defined by constraints, understanding those trends is more valuable than reacting to individual data points.